Let's say you pull $10,000 out of your IRA this year. You're in the 22% bracket, so you figure the tax bill runs about $2,200. Then you do your taxes, and that withdrawal costs you closer to $4,000. Your bracket didn't change. Nothing on your return is wrong. You just hit a tax bracket that isn't printed on any IRS chart. If you saved $1 million or more and you're collecting Social Security or about to, you're probably closer to this trap than you think. By the end of this video, you'll know exactly where it sits and 3 ways to plan around it. Now, you may be thinking, wait, didn't they get rid of taxes on Social Security? Here's why you might think that. In July of 2025, the Social Security Administration emailed roughly 71 million Americans saying the new tax law, quote, eliminates federal income taxes on Social Security benefits for most beneficiaries. Within days, they had to walk it back and post a correction. The Tax Policy Center looked at the actual law and found about half of recipients will still pay some tax on their benefits. And the formula that decides how much of your benefit gets taxed, it hasn't changed since 1993. Congress built it in 1983, froze it on purpose, and that one decision is why more than half of families receiving benefits now owe tax on them. So I'll show you the formula in a second, because once you see it, you can't unsee it. I'm Mark Fonville. I'm a certified financial planner and the CEO of Covenant Wealth Advisors. We manage nearly $1 billion for folks transitioning to and through retirement, folks in their 50s, 60s, and 70s who've done a great job saving and now need a plan that brings it all together. Retirement income, taxes, investments, we plan them as one because that's how they actually work in real life. So let's open the hood a little. Whether your Social Security gets taxed comes down to one number the IRS calls provisional income, a phrase nobody outside the IRS has ever said out loud. Here's the recipe. Take your income from everything else, IRA, withdrawals, pensions, interest, dividends, add your tax-exempt interest, then add half of your Social Security benefit. That total is your provisional income. If you're married, filing jointly, and that number is under $32,000, none of your benefit is taxed. Between $32,000 and $44,000, up to 50% of your benefit gets pulled into your taxable income. Above $44,000, and once $1 million IRA starts paying you, you're almost certainly above it. Up to 85% gets pulled in. Now, the most common misunderstanding in all of retirement taxes, possibly, is 85% is not a tax rate. It means up to 85 cents of every benefit dollar gets included in your taxable income and then taxed at your normal rate. At least 15% of your benefit stays out of taxable income under current law. So no, the government isn't taking 85% of your check. Thank goodness. What they built instead is sneakier, actually. Watch what happens when you take one more dollar out of your IRA. That dollar is taxable, obviously, but it also raises your provisional income, which drags another 85 cents of your Social Security into taxable income with it. $1 out, $1.85 taxed. In the 22% bracket, that's 22% times 1.85, an effective 40.7% on that withdrawal. This isn't my math, it's published research in the Journal of Financial Planning. Their example, a single retiree with $30,000 in benefits paid that 40.7% rate across a $9,000 band of income. They call it the tax torpedo. A quick gut check before we keep going. Has anyone ever shown you your real marginal rate with Social Security in the picture? Tell me yes or no in the comments. I read every one. Now, 2 more things about this formula because they bite affluent retirees specifically. First, see that tax-exempt interest line? Your municipal bond interest counts. Your tax-free muni income arms the torpedo. And then second, look at the shape of the thing. Your marginal rate spikes to 40.7. Then once 85% of your benefit is fully phased in, it drops back to 22. So notice something strange? Past a certain point, earning more drops your rate. So hold on to that. We're going to use it a little bit later in the video. But first, here's the part that should genuinely bother you. This trap wasn't an accident. In 1984, when this tax first took effect, fewer than 1 in 10 retirees paid it. Today, the Social Security Administration's own researchers project that on average, about 56% of beneficiary families owe income tax on their benefits. Congress never raised the tax, never voted on it again. They just never adjusted those $32,000 and $44,000 thresholds for inflation, and inflation just did the rest. That was the design. The 1983 commission left the thresholds frozen on purpose, expecting that over time, nearly all benefits would become taxable. Most tax rules feel like someone wrote them at 2 a.m. on a deadline. This one's worse. They wrote it carefully in 1983 and then never touched it again. So what did the 2025 law, the one big beautiful bill, actually do? Well, it created a temporary deduction, $6,000 per person for those 65 and older, $12,000 for a couple for tax years 2025 through 2028 only. Helpful for some, but notice 3 things. 1, it did not touch the provisional income formula, not the thresholds, not the 85% inclusion. The torpedo is fully intact. 2, it expires after 2028. 3, it phases out as income rises. Above $150,000 of income for a couple, the deduction starts shrinking. By $250,000, it's gone. So a couple, both 67, with $180,000 of income, their deduction is already partially phased out, and their Social Security tax math is identical to the year before. The White House said 80% of seniors would pay no tax on their benefits. The Tax Policy Center ran the numbers and found about half of recipients will still pay some tax, and that the rosier number leaned on some very generous assumptions. Now, I'm not here to referee the politics whatsoever. I'm just here to tell you what's true on a tax return. The formula didn't change and the deduction is temporary. By the way, there's a checklist we run with many of our clients on Social Security. Includes claiming age, the earnings test, spousal coordination, and exactly how your benefits get taxed. It's free in our retirement checklist library, and the link is in the description. But let's keep going. You can't change the formula. Congress froze it, but you can control the income that feeds it, and that's where this gets pretty good. Move 1, Roth conversions in the gap years. For a lot of our clients, there's a quiet stretch between retiring and the day Social Security and required minimum distribution switch on. Maybe age 62 to 70. In those years, your taxable income is low. Your torpedo hasn't armed yet, and you can move money from your IRA to a Roth at today's rates. Every dollar you convert now is a dollar that won't come out later as an RMD, feeding the torpedo year after year for the rest of your life. And the research says this matters a lot. In one case, Reichenstein and Meyer illustrated through Morningstar a retiree using conversions and smart withdrawal sequencing cut their projected lifetime federal tax from about $207,000 all the way down to $92,000. Now, that's a hypothetical. Your numbers will differ, but the direction is real, and the 2028 sunset changes this math. This window has an expiration date. So if this is the kind of planning you want more of, go ahead and subscribe, because the next piece of this puzzle is a full video on the 2028 Roth conversion window and how to size conversions year by year without blowing up your tax bill. This is what we do here every week. Move 2, and this is the one almost everyone gets backwards, delaying Social Security to 70. Here's the asymmetry hiding in that formula. Only half of your Social Security counts toward provisional income. 100% of an IRA withdrawal does. So a bigger Social Security check replacing IRA withdrawals can mean less provisional income and a smaller share of your benefit taxed. You'll hear that Social Security is a great deal because 15% is always tax-free. On average, that's true. At the margin, inside that hump, the next dollar can face 40.7%, but the planning is about the margin. Now picture a hypothetical couple, call them Tom and Linda, not real clients, both 66 2.5 million in IRAs. They convert in their gap years, delay benefits to 70, and arrive at RMD age with smaller IRAs and bigger checks that only half count against the formula. Same wealth, completely different torpedo. Move 3 is the one charitable retirees love. Qualified charitable distributions. Once you're 70 and a half, you can give straight from your IRA to charity, up to $111,000 per person this year. So here's why that beats writing a check. It's not a deduction, it's an exclusion. The money never lands in your income at all. Lower income, lower provisional income, less Social Security taxed, and it counts toward your RMD. One move, 3 problems. It's one of the few times the tax code actively rewards you for being generous. Savor it. One catch, by the way, order matters. The QCD has to happen before you take the RMD. Get that backwards and the offset is lost for the year. Now, before you call your custodian and start converting, every one of these moves has a tripwire, and one of them costs some retirees more than $1,000 a year per person for $1 of extra income. So Tripwire 1, Medicare IRMAA. If your income crosses certain lines, Medicare charges you a surcharge on parts B and D, and it's a cliff, not a ramp. This year, the first line for a married couple sits at $218,000 of income. Cross it by a single dollar and you can owe more than $1,000 per person per year in extra premiums. And here's the kicker. Medicare looks at your income from 2 years ago. A big Roth conversion at, say, 65 can raise your Medicare premium at 67. I've been doing this a long time and I still double check the IRMAA brackets every single time when we're helping clients. So conversions in IRMAA have to be planned on the same sheet of paper, ideally starting before age 63, the first year that Lookback can catch. If that 2-year Lookback was news to you, by the way, tap the like button. It tells me just to make a full video just on IRMAA down the road. Tripwire 2, and I'll be straight with you, sometimes none of this helps. If your RMDs and pension already lock in the maximum 85% inclusion every year, the torpedo has already gone off. At that point, chasing Social Security tax savings is the wrong target. Your real game is IRMAA and bracket management. And Roth conversions only pay off if your future rate is at least your current rate. Over-converting is a real way to lose real money, and it should be fully integrated with your investment portfolio because that's a taxable event too when you're trading it. In Tripwire 3, the survivor trap. When one spouse passes, the survivor files single, lower thresholds, 25 and 34,000 instead of 32 and 44, and compressed brackets. The same income that was comfortable as a couple feeds their torpedo harder alone. If your plan ignores their surviving spouse's tax picture, it's half a plan. And one more quick flag, 8 states still tax benefits, so check yours. List in the description, by the way. So here's what actually matters from the last 12 minutes or so. 1, the 85% number is a share included in income, not a tax rate. The real danger is the hidden band where your effective rate can hit 40.7%. Remember that $10,000 withdrawal from the start of this video? Now you know exactly where the missing $1,870 went. 2, the thresholds are frozen on purpose since 1983, and the 2025 deduction didn't change the formula. It's temporary. It phases out and it's gone after 2028. And 3, the torpedo is a planning problem. Conversions in the gap years, claiming timing, charitable giving from the IRA, coordinated with IRMAA, never in isolation. So here's your next step. Download the Social Security checklist we use with clients. It walks through claiming aid, spousal coordination, and exactly how your benefits get taxed so you can check your own plan against everything we covered today. It's free along with 15 other retirement checklists, and it's the first link in the description down below. So here's the bigger lesson from that SSA email. 71 million people got an official message about their own money, and it was wrong enough to need a correction. The formula is knowable. The trap is mappable, and the window before 2029 is real. The retirees who do best aren't the ones who react to the news. They're the ones with a plan that already saw it coming. Move number 1 tonight was Roth conversions before 2028. If you want to know exactly how that window works and how to size conversions year by year, watch this video next. It picks up right where this one leaves off. We'll see you next time.